Hello friends, my name is Behroz and welcome to my channel where I talk about things that I read, learn and apply in order to become my best version. Many a times I've heard people talk about how they've stopped investing, especially when the market is going down because they fear losing their investment. So in this video, I will talk about the cost, or let's say the price that one individual pays in terms of missing on the average returns by not being present or invested in the market, be it a good year or a bad year. Essentially, with the data, I will make a point and prove to you that at any given point in time, you should remain invested in the market in order for you to at least earn average market returns, or rather beat them. Imagine there's a genie out there which approaches you on every 31st of December and shares with you the information on US stock market for the next year. Unfortunately, the genie cannot tell you which stock to buy or how will the market perform. However, the genie does know that how much the market will be down at its worst point in next 12 months, which is referred as maximum intra-year drawdown. My question to you is, how much does the market need to go down in next 12 months for you to decide that you don't want to invest in that market or don't want to remain invested in that market anymore? For instance, if the genie tells you that the market will go down as low as 40% at its worst point in the next 12 months, would you remain invested or would you be out? What about 20%? What about 15%? So where is your limit? Before you answer that question, let me provide you with some data so you are better informed. Since 1950, the average maximum intra-year drawdown that the US market has seen is around 13.7%. That is to say, on average, the market declines by about 13.7% at some point within a given year. Here is a chart which illustrates the maximum intra-year drawdown since 1950. As you can see, the maximum drawdown occurred in 2008. This was the 2008 financial crisis of around 48%. So after looking at this data, the question is, at what level of decline would you rather sit out and not be in the market? So let's start by assuming that you go ultra conservative with your money. You tell the genie that you will avoid any year in which there is a drawdown of 5% or more. So we will call this avoid drawdown strategy, according to which you will not invest in stocks in the years where the drawdown is more than 5%, while you will move the money into stocks in all other years. So the avoid drawdown strategy is either only in cash or all in stocks. So now, using the history, let's talk the numbers. Let's assume you invested $1 in the avoid drawdown strategy from 1950 to 2020, while avoiding all years with 5% drawdown or greater. It would have costed you dearly, because by 2018 you would have 90% less money versus what you would have had if you would have owned the stocks the whole time. That is buy and hold. The chart that you see here illustrates this point. The reason you underperform buy and hold is because you are out of the market too often. In fact, you would be spending 90% of all years outside the market, with the exception of only 7 years since 1950 where you will be invested in the market. Other than that, you would remain outside the market and hence you would underperform versus buy and hold. This can be illustrated by looking at this chart, which highlights when the avoid drawdown strategy is sitting in cash. Note that this chart is similar to the chart that I've shared before, with the exception of gray shaded area, which identifies when the drawdown strategy is sitting in cash. As you can see, since you are in cash so often, you rarely participate in the growth of the stock market. By taking no risk at all, you will be underperforming the buy and hold strategy by a significant amount. So if you want to grow your money, you need to be comfortable with drawdowns. This is just a risk that you need to accept in the short term in order to allow your money to grow in the long term. So net, the point that I want to make is that the price or the cost of staying out of the market just because you fear downturn in the market in a particular year is very high. Hence, in my case, I always try to take a long-term lens for my investments. I try to avoid following the downturns in the short term, rather keep an eye on the long term. Especially given my confidence in the US stock market, I'm confident that in the long term, the stock market will continue to deliver the returns in almost similar range that it has delivered in the past. Thank you for watching this video. Hopefully this video was helpful for you to now rationalize and understand the cost of staying out of the market when the market is going down.